Earlier in the year, I talked about the strategy of Speaker of the House Paul Ryan in passing tax cut legislation. At that time, the tax cuts were being supported by or being funded by a border adjustment tax, which was like a import tariff, general import tariff of 20 some percent, and that was going to provide around $1.4 trillion over 10 years, which would be available to fund the corporate tax cuts and also the personal tax cuts. Now, the problem about the US system, uh, a little bit different to ours, is that they're very dependent on donors, corporate donors. And it turns out the two major corporate donors to the Republican Party, that is to say Walmart and, and the Koch brothers, decided that a border adjustment tax would dramatically increase their cost of doing business, and let it be known that the result of that would be a much lower level of donors to the Republican Party. So that way of financing the budget deficit that would result from corporate and personal tax cuts got put away with. Now, how else do you fund $1.4 trillion of pretty much anything? Well, the simplest way that most politicians will do that is just run a budget deficit. But in the long term, you can't get anybody to run a budget deficit. After all, one of the big things that Republicans believe in is balancing the budget and keeping the debt to GDP ratio in balance. So, how do you get your way around that issue? Well, you demonstrate that these corporate tax cuts are actually going to generate higher growth, and that higher growth will reduce the budget deficit. And and that's what this piece does. It shows with quite a lot of high quality economic analysis that if you cut corporate tax rates, then currently around about 30% of US corporate earnings made domestically in the US are being invested not in the US, but are being invested offshore where they can get investments at lower tax rates. Now, I'll just take it to just a touch complicated, just lift it up just a slight level. One of the really interesting things in this paper is it demonstrates the difference between effective tax rates, which are the tax rates after you write off all the tax deductions and depletion allowances which are available in the US, and the marginal tax rate, corporate tax rate, which you then face after those write-offs are exhausted. And it turns out that even though the Congressional Budget Office says that when you take all those write-offs in the US, the effective tax rate in the US is not 35% for corporations, it's way down at 19% because you've got all those tax deductions reducing it. But once you've spent all of that, you've taken all of those tax deductions, the marginal tax rate that you're then facing for more investment goes back to that headline number of 35% because you've exhausted all your tax deductions. And at that point, you then decide where's the extra dollars going to be spent when you've used all those tax deductions. And that's when you pick sending the money to the country with the lowest tax rates. And the two I could most quickly think of and put in the piece was Canada, which is, as Paul Ryan says, it's overseas because it's the other side of Lake Michigan, which has a corporate tax rate of 15%, and across the Atlantic, Germany got a corporate tax rate of 50%. So that's where the money goes, and 30% of US corporate taxes is currently going overseas because of that marginal tax problem. Okay, so when you cut the tax rate down from 35% to 20%, what the paper says is that 30% comes back and is domestically invested in the US. So you have a much higher proportion of US corporate profits invested in the US, then it generates more investment, which generates more growth, and interestingly, higher wages. Another interesting thing about the paper is that it shows this comparison of low tax countries with low rates of corporate tax versus countries in the OECD with high rates of corporate tax. And it really does show that companies that have lower levels of corporate tax rate do have a higher level of investment, and that generates a higher level of growth, and that really does generate high levels of real wages. So this quite serious piece of economics that's been published by the Committee of Economic Advisors, which advised the president, really does show that if you cut corporate taxes, you will get higher growth and therefore reduce the budget deficit. Okay, so where do we go from here? Well, where we go from here is in the last 10 days, the US Senate has passed a budget deficit, passed a budget for next year with a budget deficit of $1.5 trillion for the next 10 years. That's because we don't have that import tax anymore. And last night, the House of Representatives also passed that budget through the House of Representatives with a budget deficit of $1.5 billion over the next 10 years. Now, the reason they both agreed on doing that is because of the piece of piece of research you've got in front of you, which says that what's going to happen over extended period of time is that budget deficit's going to reduce because higher investment. Okay, now turns out that $1.5 trillion is exactly the amount they need to finance the tax cuts. Isn't that convenient? So what you'll now have is a budget reconciliation bill, which will be agreed on by the House and the Senate, which will include the detail of those corporate tax cuts. And as a budget reconciliation bill, it can't change the budget deficit. Hey, you don't have to anymore because these budget documents have done that. But you can change the tax rates, and that can be passed through the US Senate with only 51 votes. So now you know why this piece of research was done, and it was done to convince both houses to pass a budget with a budget deficit big enough to finance the tax cuts. Now comes the part of framing the legislation and the actual size of the tax cuts. But hey, if you've got the money and they already have the money, you can now do the job.